Hey, it's Josh. I'm here with Mike. Michael posted a chart yesterday that just went absolutely thermonuclear on social media. We're going to talk about it. Stick around. Before we get into the blog post, Mike posted this chart on Twitter, and what he was attempting to show in doing the research was that we're not in a market where there's only 5 stocks going up, even though that's the impression that could be created because of the huge market cap gains for, Facebook, Amazon, Apple, etc. And then he did this thing, and we're putting the chart up now, where he's showing that the bottom 200 some odd S&P 500 companies all combined add up to the same market cap as the top 5. And then he went really into the data to show that that's not that unusual. Mike, why do you think people flipped out? And by the way, before you answer that, your tweet got 1 million impressions, 125,000 total engagements. I don't know how many retweets, how many likes, but it's like nothing that we've seen in a long time, right?
Yeah.
So just people flipping out because of the way that you showed the data, or were their minds blown, or some combination?
Yeah, but it's a lot of all of that. I think the reason why this chart to me was so interesting, and that's all I thought that it was, is because this is just a really good visual representation of how an index fund works. So in other words, Yum can triple. And
Yum Brands.
Yum Brands could triple. It could literally triple, and it would have the same impact on the index as if Apple just gained 1%. So to see this visually of how an index fund works, I think blew people's minds. And then there was the whole, these 5 stocks do not make up 50% of the S&P.
Because you showed it right. So you showed it as a pie chart, and so it looks like you're saying, here's the other 495 stocks.
Right, which was certainly not my intention. And I literally wrote exactly what that chart showed. So I apologize to people that didn't read it and got mad or came to the conclusion that this will not end well. What maybe is different about these 5 stocks are that they are all sort of tech. And I say sort of because obviously AWS is a huge driver of Amazon, but they're like a retail company. And then Facebook.
It's a consumer discretionary according to the S&P.
So Facebook, what are they? I mean,
well, that's going to change this fall. They're going to take Facebook and Netflix are going to be in this communications basket. They're going to come out of technology, but that's like a whole other conversation.
Previously, it used to have a mix. It used to be Chevron and Procter & Gamble and Merck and Coca-Cola.
Yeah, it's not.
And when you see the 4 horsemen, it's a holy shit, this is crazy type of situation.
I also think people get triggered who have diversified portfolios and they have big weightings to stocks that are not doing anything really this year. There are a lot of financial stocks that really aren't doing anything, and consumer staples have actually been down.
Right, but so it is interesting because the original thing that I set out to do was to show that it is not only the mega cap stocks that are going higher. Of course, by definition, they're leading the index. But I broke it down into deciles, and there's a lot of stocks that are doing just fine.
Right. The thing is that they don't matter. So I'm looking at some of the smaller names. The bottom, what is it, 228?
The bottom 282.
282. So I'm looking Vornado Realty Trust, Raymond James,
names. Hershey, Tiffany,
E-Trade. Marathon Oil, Wynn Resorts. They're not small. They just don't even matter. And I think that's what's making people unhappy, or it's a...
But the notion that the only stocks going higher are the mega caps.
So that's not true, right?
Completely fallacious. Look at the advanced decline line. Look at the equal weight. Look at, if you break it down into deciles like I did in the post, it is not only the bigger stocks going up, but of course they are moving the index. And the reason I think, again, why this went totally viral is because it's such a powerful visual of how index funds actually work in real life.
So all right. So we'll link to the post in the notes here. So you have S&P 500 total return by decile, and so the top decile. So the
50 biggest names.
Basically, the 50 biggest names in the S&P are up 8.8% this year on average, and then you're showing that the second decile is 6.2. The third decile is 7.1. The fourth decile is 9.6, actually outperforming the top 50 names. And I think that's a really interesting way of understanding what you're trying to say.
Yeah, so the 50 stocks in the bucket 150 to 200 are doing better than the 50 mega cap
right.
stocks.
You would never know that because it's not as salacious.
Right, so I was trying to debunk the headlines and I had the opposite effect.
Our friend Patrick O'Shaughnessy threw up a chart. It's not brand new, but it's recent enough that it's worth thinking about. The Pareto Principle that 80-20 in markets is somewhat constant. He has data going back to, what is this, the 80s?
I think 60s.
Or the 60s rather, and he's basically saying 20% of stocks represent roughly 80% of market sales and market cap. And that really does not change a great deal over time. Maybe it's toward the higher end of the range right now.
So these 5 stocks represent 16% of the index, which is not extraordinary. Back in the day, AT&T...
16.
Back in the day, AT&T and General Electric alone, or I'm sorry, AT&T and General Motors, I believe, was like 20% of the index.
Right. So this is like something that we've seen before. And then one last thing, you have a chart here, I think contributed by Lawrence Hamptel. You're looking at the top 5 weights in the S&P. You get 15.16 right now.
It's 16.
16, but then you're showing like the 1970s was 25%.
Right.
Like people weren't up in arms or saying the market advance is fraudulent or anything like that. So I think like maybe we have too much data. Maybe it's too easy to run the calculation of how much a stock contributed to the market, and somebody that's inexperienced or ahistorical just like flies off the handle and forms their own opinion.
This is a great example of what Kahneman calls what you see is all there is. You see this visual and it just bugs people out.
And you called it a Rorschach test too. Like if you wanted to be negative, it gave you a reason to be negative, even though it's not negative.
I don't think so.
Okay, so to conclude, people are out of their minds. Markets are fun, and there are some things that are more constant than you think. You just have to actually, I don't know, read about it or look at the numbers before forming a wild opinion that is just false. Would you say that's right?
Yeah, I'd also say it's a sort of weak ending.
What's that? You don't like how we're ending this?
Weak closing remarks.
Too bad. That's it from us. Turn off the camera.